Hello, everyone, and a warm welcome to this discussion brought to you by the experts over at Pro Tax Accountants. Today, we are getting into a really critical question, one that honestly trips up so many home buyers. What on earth happens with stamp duty when you're buying a new home, but you already own another property? Trust me, it's a situation that's packed with financial traps, but we're here to give you the map to get through it.
So let's just jump right in. Does this sound familiar to you? You've found your dream home, you're excited, you're all set to move. But, and it's a big but, you still own another place. Maybe it's that flat you used to live in that you now rent out, or a little holiday cottage, or perhaps even a property you inherited. If that's you, then you really need to pay close attention for the next few minutes.
Because a number just like this could be waiting for you. Yep, that's £22,500. And no, that's not for your deposit, it's not for new furniture. This could be a surprise tax bill that lands right on your doormat, and I'm going to show you exactly how this happens, why it happens, and most importantly, how you might be able to get every single penny of that back. So, here's what we're going to cover. We'll start by breaking down this surprise tax bill. Then we'll explain the surcharge itself and who exactly gets caught by it. After that, we get to the good stuff, how to claim your money back. We'll also look at some key exemptions and other reliefs, and we'll finish up with the most important things you absolutely need to remember. All right, let's get to the heart of it. The higher rates of stamp duty land tax, or SDLT, as you'll hear it called. This is exactly where that unexpected and often budget-breaking bill comes from. And it was all designed with one specific goal in mind. Okay, first, a super quick refresher. SDLT is the tax you pay when you buy property or land in England and Northern Ireland. Simple enough, right? Well, back in 2016, the government added a surcharge, which is basically an extra layer of tax. The idea was to cool down the buy-to-let market, making it pricier for investors to scoop up homes. And hopefully that would free up more houses for people to actually live in as their main home. Now, the trigger for this extra tax is deceptively simple. On the very day you complete your new home purchase, if you own an interest in another residential property worth $40,000 or more, bam, the surcharge applies. And you have to notice that crucial little detail. This applies to property owned anywhere in the world. That holiday apartment in Spain, that rental property in Dubai, yep, it counts. So how much extra are we actually talking about here? This is where we get into the numbers. And you'll see how that £22,500 figure from the beginning suddenly becomes very, very real. Just look at this table. It shows the difference so clearly. On the left, you've got the standard SDLT rates for the 2025-26 tax year. But on the right, that's the higher rate. And this isn't just a small bump. We're talking a full 5% added on top of every single tax band. Even that first slice of the property price, which is normally completely tax-free at 0%, suddenly gets hit with a 5% tax. It is a massive jump across the board. To make this real, let's meet Priya. She's a freelance graphic designer in London, and she's buying a new home for £400,000. This is going to be her main residence. But she also owns a small flat that she bought a few years back and now rents out. Because of that one single flat, she falls directly into the higher rates trap. And here's the damage. If Priya didn't own that other flat, her stamp duty bill would be £7,500. A big cost, but one she would have planned for. But because she does own it, the surcharge kicks in and her bill skyrockets to £30,000. That is an extra £22,500, exactly the number we started with. It's a colossal difference that can completely throw your finances off track if you're not ready for it. Now, you might be thinking, okay, I get it for landlords like Priya. But that's not all, and here's where most people go wrong. The rules for who has to pay this surcharge are incredibly broad, and they catch so many unsuspecting homebuyers by complete surprise. The net is cast very, very wide. For instance, if you're buying a home jointly with someone, and just one of you owns another property, the higher rate applies to the entire purchase for both of you. But the rule for married couples is a huge one. Stay with me. This next point is a common and very expensive trap. Okay, listen up because this is a massive pro tip. For stamp duty, HMRC treats married couples and civil partners as a single entity. What does that mean? It means if your spouse owns a buy-to-let, even if they owned it long before you even met them and the name isn't going anywhere near the deeds of your new home, you will still have to pay the higher rate. This one single rule catches so many people out. And just when you think it couldn't get more complex, there's another layer.
If you're not a UK resident for tax purposes when you buy, you get hit with an additional 2% surcharge. And yes, that gets stacked right on top of the 5% higher rate. So you could be looking at a total surcharge of 7%, which really just goes to show why getting professional advice for your specific situation is so critical.
Whew. Okay, so we've laid out the problem, and I know it can seem pretty daunting. That £22,500 is a huge sum of money to find out of the blue. But what if I told you that paying this surcharge doesn't have to be the end of the story? What if you could get that money straight back into your bank account?
And this brings us to what is, for many people, the most important part of this whole discussion: the refund. Yes, there is a specific way you can reclaim every single penny of that surcharge, but you absolutely have to follow the rules to the letter. So here's the crucial point. The surcharge is really designed to tax second homes, not people who are just moving from one main home to another. So if the property you're buying is replacing your main residence, you can claim a refund. The absolute key condition, the one you cannot forget, is this: you must sell your previous main residence within 3 years, that's 36 months, of buying your new one. And here's how you actually do it. Step 1, confirm you're eligible, that the property you sold was definitely your main home and you sold it within that 36-month window. Step 2, gather up your documents, especially that original SDLT return. Step 3, you need to fill out a specific form called an SDLT 16. Finally, step 4, submit it to HMRC. But don't hang about. You only have 12 months from the date you sold your old home to file for that refund.
Now, getting a refund is great, of course. But what if you could avoid paying all that extra tax in the first place? Let's explore a few other ways you might be able to legally lower your bill from the get-go.
Now, this slide highlights a huge one: mixed-use properties. If you buy a property that has both residential and non-residential parts, the classic example is a shop with a flat above it, the rules change completely. It gets taxed at the lower non-residential rates, and crucially, that 5% surcharge does not apply at all. And just look at the example. On a $500,000 purchase, that difference could save you an incredible $23,000.
And here's another little fun fact for you. Remember that £40,000 threshold we mentioned for the additional property? Well, if your other property is actually worth less than that, the surcharge doesn't apply. This also goes for things like caravans or houseboats, because HMRC doesn't see them as residential property for the purpose of this particular tax. All right, we have covered a lot of ground, I know. So let's boil it all down to the key things you absolutely have to remember as you go through your property purchase. Okay, here is your final checklist. First, that 5% surcharge is the big one, triggered by owning another property anywhere in the world worth over $40,000. Second, please never forget that married couples are treated as one unit. Third, that 36-month refund rule is your lifeline if you're simply moving main homes. Also, remember the extra 2% for non-UK residents and the potential savings with mixed-use properties. And finally, and this is the most important one, for anything complex, always get professional advice. And let's be honest, this stuff is complicated. It's a really complex area of tax law. The examples we've used today are pretty straightforward, but real life is rarely that neat, is it? Your personal situation could involve trusts or inheritances or company structures that can change everything. For personalized advice that's tailored to your exact situation, it's always best to speak to the experts. The team Pro Tax Accountant are ready and waiting to help you navigate all of this. You can reach them directly on WhatsApp or by phone at 07985 689912, or you can drop them an email at info@protaxaccountant.co.uk. They can help you with your stamp duty questions and pretty much any other tax issue you might have. And hey, if you found this guide useful, please make sure you subscribe to their YouTube channel for more clear, practical tax advice just like this. Thanks for joining me.